and welcome to my session 7 video. Today we will be discussing CAPM and cost of equity analysis. So basically we have to determine the cost of equity for 3 different companies with varying risk profiles using the capital assist price model known as CAPM. As an analyst for a venture capital firm, we must calculate required returns for investment evaluation and provide strategic recommendations for cost of capital management. The analysis occurs in a rising interest rate environment with compressed technology valuations. So we have 3 different companies, as you can see. We have CloudTech, Regional Bancorp, and Green Energy Utilities. We have different market parameters we have to consider, such as risk-free rate for 10-year treasuries is about 4.5%. Market risk premium is about 6%, and expected S&P 500 return at about 10.5%. Some context for the market: Federal Reserve are maintaining higher for longer rate stance, and technology sector valuations compress 30% from peak. Flight to quality amid economic uncertainty as well. Required analysis, of course, is going to be calculate the cost of equity for each company using CAPM, explaining beta differences across industries, analysis of strategies for CloudTech to reduce cost of capital, assess recession impact on required returns, compare CAPM estimates. And to solve all this, we must use the driver framework as a requirement. We must use driver to conduct analysis, not to describe to complete work respectively, but much deeper than that. So if we move to my driver framework that I have, so for my define and discover the goals to determine the cost of equity for 3 companies, I just kind of went over this. Here are the parameters and our companies. We must represent the relation between risk, which is beta, and expected return is formally represented by the CAPM equation, which is going to be RE equals RF times beta, all multiplied by RM minus RF. This model establishes the minimum return an investor should expect for holding the company's equity, considering its systemic risk exposure. So to implement this, we just follow the formula for each of the companies. So for company A, we're going to have 4.5% plus 1.8 times 6%, which is going to be equal to about 4.5% plus 10.8%, which is about 15.0%. For company B, it's going to be 4.5 plus 0.9 times 6%, which is going to be about 4.5% plus 5.4%, which is going to be about 9.9%. And for company C, we're going to have 4.5% plus 0.5 times 6%, which comes out to be 4.5% plus 3%, which comes out to be about 7.5%. So to validate this, the results align with the expected risk profiles. So they're high RE for CloudTech, 15.3% is validated by its high beta, about 1.8, reflecting its sensitivity to market swings and reliance on long-term growth, most sensitive to the discount rate. For the low RE for Green Energy, which is about 7.5, this is validated by its low beta of about 0.5%, reflecting its stability and defensive nature. The calculations confirm that the cost of equity is higher for the high-grow, high-risk company and lowest for the regulated utility. If we want to evolve this, we must attack the core problems for CloudTech, as it is punitive, about 15.3% cost of equity, which is severely reducing its net present value in the current high-rate environment. Strategic recommendation must focus on reducing its weighted average cost of capital, which is WACC. So strategy 1 would be de-risk their revenue, focus intensely on converting short-term contract to long-term, non-cancelable software as a service, SaaS subscription, predictable cash flows, signal stability, inherently lowering the beta. We could do some operational leverage, such as achieve a clear pathway to positive free cash flow. This reduces dependency on equity markets and lowers investor risk perception. For 2, another strategy, we have introduced strategic debt, such as since CloudTech is about 100% equity finance, introducing venture debt or leveraging finance can lower the WACC. Debt is typically cheaper than equity and offers a tax shield, immediately providing a lower blended cost of capital. So we must target the WACC, of course, is another goal. The goal is to lower WACC below 5 point or 15.3% to justify higher valuations. So to reflect on this, the comprehension CAPM analysis yielded distinct required returns. CloudTech is about 15.3%, Regional Bank at 9.9, Green Energy at 7.5. This basis point spread highlights the market's acute sensitivity to systemic risk, which is known as beta, and the current higher for longer interest rate environment. So my final net assessment, CloudTech, was a high risk high maintenance mandate. The 50.3% RE acts as a stringent hurdle rate for all investment decisions, such as RD, projections, acquisitions. Investment evaluation must project returns and significantly above the rate, often 2 times up to 3 times to absorb the risk of tech sector volatility and compressed valuations. Action. So my call to action will be investment is justified only in the VC firm has a credible plan to plan management, execute the beta, reduce strategies, stabilizing revenue, achieving cash flow positively, and to lower the future cost of capital and increase equity value. Green energy, of course. This is a low risk but preservation mandate. This low 11.5 RE value validates its status as a defensive asset while it won't improve venture scale returns. Its low WACC makes large scale impact. Long-term infrastructure projects feasible and support stable premium valuations relative to its earnings. My call to action for this: if the VC firm needs to temporarily shelter capital from economic uncertainty, green energy provides a secure store of value due to its low correlation with the broader market. Uh, Market context reflection: the current macro environmental demands that investors recognize it's a true economic cost of equity for high growth, high beta companies has permanently reset higher compared to the previous decade, relying solely on historical valuations on a lower risk free rate will lead to poor investment decisions. So while determining the quote unquote best company depends entirely on the venture capitalist firm, such as risk mandate and return objects, Company A, CloudTech, is the best choice for a firm dedicated to high risk, high growth venture returns, while Green Energy Utilities Company C is the best choice for a firm prioritizing defensive stability capital preservation. Company B, the Regional Bancorp, is likely the least suitable as it is required return on 9.9% is too low for the risk appetite of a VC fund, which typically targets exponential growth. CloudTech, on the other hand, with a high RE of 15.3%, offers the highest potential reward but carries the greatest risk of about 1.8% or 1.8. Its success hinges on its ability to navigate the current high rate environment by aggressively implementing risk mitigation strategies to lower its effective cost of capital over time. Conversely, Green Energy Utilities provides immediate safety with the lowest required return of 7.5 beta, which is of 7.5%, which is about 0.5 beta, making it an ideal defensive asset to hold during periods of economic uncertainty, though it offers limited growth upside. Ultimately, if the firm remains committed to its core mission of generating outsized returns, CloudTech preserves the necessary, albeit challenging opportunity, provided the firm can successfully guide the company in stabilizing its cash flows and optimizing its capital structure. Now, moving forward to my coding. So we must analyze the cost of equity for the three companies, with varying risk profiles. So we must, we have an example of the risk-free rate, example of the market risk premium, and an example of the expected S&P return. Kind of went over that earlier. So company data, which we're gonna calculate, we're gonna need to find out all the beta, all the. I'm so sorry, I don't know why I'm drawing a blank. The highest risk, of course. Anyways, so we got to calculate the cost of equity. So in order to do this, we must use beta, cost of equity, and the cost of equity, we kind of calculated this earlier together. For the company A, it's going to be 7.5, company B is 9.0, and for company C, it's 10.5. We must construct security market lines. This was asked of us to include in the video, so we must create a list of beta values for plotting the SML. We must calculate the corresponding expected returns for the chart for the security market line. Extract the company beta and cost of equity for plotting, and create scatter plot, of course. Add labels, create the line plot, add labels and the axis, and here's what we have. We have combined all of our um charts into one, so we have company A, B, and C all in a linear, motion. So describe the meaning of beta and its relation to risk profiles for each company. So understanding beta and risk profiles. And beta is a measurement of stocks' volatility in relation to the overall market. In the context of the capital asset pricing model, it quantifies the system. Um, Meaning company stocks is less volatile than the overall market. It is expected to move in the same direction as the market, but with smaller price swings. The risk profile indicates lower systematic risk compared to the market, and so on and so forth. So for beta is a measure of a stock's volatility in relation to the overall market, as I kind of mentioned in the context of CPM. So for A, it's going to be about 0.7, meaning A's stock is less volatile than the overall market. It is expected to move in the same direction as the market, but with smaller price swings. For price B, we have a beta of about 1.0. The company B stock is volatile, kind of similar to the overall market. It is expected to move in line with the market, and its risk profile indicates systematic risk comparable to the market. For C, it's the highest of 1.3. Stock is more volatile than the overall market, expected to move in the same direction as the market, but with larger price swings. For the risk profile, it's going to indicate higher systematic risk compared to the market. So the influence on the cost of equity, according to the formula, a higher beta directly leads to a higher calculated cost of equity, assuming a positive market risk premium. This is because investors require a higher return for taking on more systematic risk. So to analyze these differences, we basically just compare them each, the factors influencing the company's beta, and describe the characteristics for each. So for A, we have beta of 0.7. Assume the company A operates in a stable, non-cyclical industry such as utilities or consumer staples. Its business model is likely mature, so on and so forth. For company B, we assume it operates as a diverse industry that closely mirrors the overall economy, I should say, such as large established manufacturers or services conglomerate. Company B, we're going to assume it's a young, growth-oriented company in a technology-driven industry such as cutting-edge software, biotechnology. Its business model may involve high operating leverage, significant fixed costs for research and development, and its revenues could be highly sensitive to market sentiment and economic growth. It's likely it is an earlier rapid growth stage. Joe's justification for this: technology and growth companies are often more sensitive to economic cycles and investor confidence. So general factors influencing companies' beta: its operating leverage, the financial leverage, and the sensitivity to economic cycles are all three factors that affect the company's beta. You know, operating leverage gives a higher operating leverage, makes the company's earnings more sensitive to changes in sales, as financial leverage is higher financial leverage can increase the volatility of earnings per share, and the sensitivity to economic cycles is where companies whose revenue and profits are highly correlated with overall economic cycles will have higher betas, of course. So that's why it's one of the highest. So this cost of capital management for cloud tech. To do this, we must strategies, assume them. discover operational changes to affect beta, managing financial leverage and its trade-offs, effective communication with investors. So this thing loads. I'm not sure why it's not running. Maybe we can come back to this. To analyze the scenario impact, we must. Is it gonna load? This one loading. I was getting this one loading. Something's wrong with that one. So what do we have? We have impact of economic factors on required returns. Considering the companies, A has a high beta, that means lower beta, while B has a higher, and C with the highest beta, and it's expected to be more significantly impacted by a recession. C, of course, that is. And for B, its required return would likely increase in line with the overall market, kind of discussed earlier. Changes in the risk-free rate have a parallel impact on the required returns of all assets. If you go through this example, you can see why. I can't really go through it right now. Impacts of variations in market risk premium. The market risk premium is the extra return investors expect for investing in the overall market, so on and so forth. To discover limitations of CAPM and alternative approaches. I'm not sure what's going on. My Wi-Fi seems to have disconnected. My apologies for this. Not sure what's going on. Come on. So key limitations of the capital asset pricing model. While the CAPM is a widely used model for estimating for the required rate. Why is this taking so long? There we go. The required rate of return on equity investment has several limitations, such as reliance on historical data, assumption of rational investors, difficulty in accurately determining inputs, only consider systematic risk, assumptions about market efficiency, and single factor model. Alternative models and approaches for cost of equity would be given the limitations of CPM, FAME French, three-factor model, build-up method, divided discount models. To summarize our findings and recommendations. So we have the beta of all three companies, the cost of equity, uh, a little description behind it, the impacts of the current economic environment, strategic recommendations for C, given Classic's higher beta and the challenging economic environment, strategic cost of capital management is critical. For C, sorry, that was my apologies. For A, companies with lower betas like Company are relatively less impacted by amplified effects of increasing market risk premium or sector-specific valuation changes. However, they are not immune to the rising interest rate environment. This is a little summary of everything that was calculated. Beta coefficients indicate stock's volatility. Company A's low beta is attributed to hypothetical characteristics. Company B is explained by its hypothetical operation. Company C is linked to this hypothetical characteristics as a young growth-oriented company. So that is my session 7 video. Thank you guys for watching.